Good morning, everyone. The freezing spring weather here is still in effect in the Midwest. This is the pre-market morning report for Tuesday, May 12th, 2026. We just got the release of the CPI data for the month of April. So let's check in with the futures and see what the reaction is so far. We've got the crude oil at around $101.32. So the crude oil is definitely starting to move back up here. The war is apparently kicking into a higher gear. The peace talk negotiations have all but disintegrated. Iran is committing submarines to the waters, and Trump is talking about more military action. There's more saber rattling from Israel. Hezbollah struck Lebanon, and the whole situation is rapidly spinning out of control again. So we see the energy market getting a bid here to the escalation of the conflict. We have the gasoline at 370 almost. So the gasoline is almost at the multi-year high again. So we had that correction last week where we dropped about 4,000 ticks, 3,000 ticks, 4,000 ticks. In the last few days, we have made all of that back almost. So it looks like the gasoline is set for some new multi-year highs here. The gasoline has not been this high since the start of the Ukraine war. We have gold coming off a little bit. It got near 4,800. The resistance looked to be about 47.75. So the gold is starting to come off a little bit. The support is in here at 46.80, 46.60 area. This big strong candle that closed near the 20 period moving average. This close 4,700 is pretty solid. The last couple of sessions could not really get through there. So gold is coming off a little bit, but it has made a recovery out of the trough it was in from 45.20. So it looks to be about the floor here, 45.20. And we've rallied a couple hundred handles off of that. The NASDAQ is coming off of the all-time high. It is still very overdone, perhaps. The AI mania continues. It seems that technology will solve all of our problems. Judging from the price, it's definitely the end-all be-all for any investor these days that's looking to catch some alpha. People are piling into tech stocks at a pace that we've never seen before. This is the most powerful rally in history. It's up about 6,000 points in a month. I've never seen anything like it. The ES is a similar story, 74.15, holding on to the 7,400 mark. We did not quite get to 7,500. I thought we would have touched it by now, but perhaps the rally is running out of steam. We can see from the time chart, and let me make sure that my hotkeys are working here. Okay, excellent. So we can see from the time chart here that NASDAQ hit the first critical support, bounced off of it, and then went through the first critical support and promptly traded the previous day's low. And then now we hit the S2 here. So now the buyers are getting really serious. The bull definitely needs to defend the S2 here. If they lose the S2, that's a critical price, and the market could definitely start to extend lower. You can see that we're still inside this dominating daily candle, and we have this little candle here. So the S2 is closer than it would normally be under a more expanded range, but it still needs to be defended and held nonetheless. We have the market hanging around the European Open. That's the euro symbol with the green line, and this is the previous day's low here in pink. The gold has come off. It hit the first resistance last night. I made a trading script video where I went over the setup of the Globex Asia trade. That resistance proved to be solid. We have not gone back up there, and we have gone down pretty much ever since we hit that resistance. So we're on an 80 handle break from hitting near the R1 here. If we look at the crude oil has been rallying all night long steadily. definitely due to the escalation of conflict. So we opened the session around here, 98.50. We moved up, got through 99.5, the first temporary resistance. Then we got through the previous day's high here at 100 and about 40 cents. And now we're grabbing onto the 101.50 area. Here's the opening range. 167 to 101.37 of the first couple minutes of NYMEX. So it looks to be a opening range breakout trade developing here in the crude oil. Let's look at the headlines. U.S. consumer prices are rising at their fastest pace in 3 years. Well, inflation is a problem. Prices of everything are going up at rates we've never seen before, particularly at the grocery store. And now with the energy crisis, the gasoline is now starting to go up a lot too. So we're being hit from both directions at this point. So we've got food prices going up, we have fuel costs going up. This is a recipe for disaster. Bearing in mind the one-off impact of the BLS correcting for shutdown-related distortions in rent and shelter from last October, this morning's CPI was expected to come in hot as the impact of the Iran war starts to spread. Energy, airfares, transport, and the melt-up in memory costs unrelated to war as the token wars continue. Well, the war is definitely continuing. As a reminder, March saw headline CPI inline energy, while core CPI actually printed cooler than expected, and we suspected most attention will be on the core side again today, with investors looking through short-term energy-driven cost pressures. Let's look at those short-term energy cost-driven pressures. Short term is the dialogue they're using today with investors looking through. So investors looking through the short term energy driven cost pressures is magical thinking that the worst energy crisis in history is going to be resolved in a timely manner and that things are going to go back to normal the way they were before. This is probably not going to work out the way they think it is. And I have something for us to track the energy crisis in real time. So Claude and I sat down and got to work last night, and here it is. This is the Hormuz deficit clock, which tracks the energy crisis in real time. Global crude oil supply destruction. It's got the date here. This is in UTC time. The strait is under blockade, elapsed since February 28th. We're 73 days into this. 13 hours, 29 minutes, and a few seconds. The total barrels of crude oil lost since the closure is estimated at 956,304,000 and counting. We're really burning 150 barrels every second off of the global supply. That's not making it there. 13 million barrels a day. This is the reality every single day. We see the stock market continue to hold on the all-time high. We see the news continue to spin the rhetoric that investors are looking through the temporary energy crisis. And we're losing 12% of the world's supply, basically. We're missing a lot of crude oil. The effective supply is 91 million right now. The global demand has not changed at 104 million barrels per day. The world's demand is not being destroyed yet. The message has not been received. We're losing we've lost about 7,000, 8,000 barrels already this minute. We've lost 310,000 almost in the hour. So 30 minutes into the hour, we're already missing 310,000 barrels. We're going to lose another 13 million today, and we're going to lose another 91 million this week. This is a cumulative effect. So this effect continues to build on itself. And if the strait were to reopen today, It takes months for production and distribution to normalize. The infrastructure needs to be repaired. The facilities need to be checked before they come back online, etc., etc., etc. We have drawn so far out of the SPR 176.92 million, so almost 177 million barrels out of the SPR, the Strategic Petroleum Reserve. We have about 388 remaining. Commercials are down 353 million, so commercial inventories have already been depleted by 353 million. Demand delta, which is the estimated demand destruction, economic activity destroyed, is 234 million. The structural hole that remains is 191.27. So what this actually means is that this 956 here, 176 of it was taken care of with the SPR. The commercials accounted for the other 353. The demand destruction, 234. The structural hole that remains is 191. So this is not going to be met by any of these other methods. You can see that in the SPR, we have 388 remaining out of 415. We have distillate stocks down 11.5% versus the 5-year average. We have commercial crude inventories right now sitting at 453 million barrels. So this is what we've got left in order to manage this crisis. The IEA coordinated release was 400 million barrels, of which the United States was 172 million of. So we contributed a majority of this IEA coordinated release. Vessel traffic remains at 5%. So that means that 95% of the traffic that usually goes through the Strait of Hormuz is not going through. This is having a catastrophic effect on supplies, particularly fertilizers, liquefied natural gas, oil, of course, and anything else related to products that are made from oil, distillates, fuel, heating oil, etc. The US SPR max draw rate is at about 4.4 million barrels per day, covers only a fraction of the 13 million global deficit. The current crisis versus the worst historical analog on record in the 1973 Arab oil embargo, which was about 450 million barrels total disruption. This is already 2.13 times the size of that crisis. This war premium analysis is this interesting thing that I came up with. So this is a synthetic fair value model. This is based on physical fundamentals, not future sentiment. Assuming the strait reopens September 5th of 2026. So I'm allowing for 3 or 4 months of this to drag on at least. The pre-war oil price was 65. The current price of WTI is 101. The discount is about $47 a barrel still. So the Goldman estimate was 149 and the current peak is 117, 118. So this is as high as we got. The fair value projected by Goldman was 149. That's still a discount of $47. So the current price compared to the fair value price, there's still a $47 discount here. The price is actually potentially much higher. The fair value of the price is potentially much higher. And that would put the war premium at $84 a barrel. So what are the components of this? How am I coming up with these numbers? So the premium component here, the physical basis is physical supply shock, 13 million barrels a day, 12.5% of the world's supply. 2008 was the comparison, hit 147 on zero physical shortage. So there was a crisis in 2008 where the crude hit almost $150. There was no real physical shortage there. That was just a market scare due to the conditions that were present at the time. So there's a $22 roughly estimated comparison, and we have an actual shortage here. So cumulative inventory depletion, 936 million barrels burned. That's 956 this morning. Restock demand surge on reopening, $18. So as soon as there is crude oil and products available, everybody scrambles to buy them all at once because now they're available so that they can prepare for the next crisis. They don't want to be caught like they have been this time around, where they're wondering if they can even get their products. Refined fuel stress, distillates 11% below 5-year average, diesel plus 30% year over year. There's another $12 roughly right there. Tanker logistics insurance, 3.8% haul versus 0.25% pre-war. 5 transits a day versus 138 normal. Another $14 added in there. Duration and mine clearance lag past 65 10-week adverse 140. September 5th reopened, 6-month mine clearance, December forward 81.50. There's another $18 right there. So, in short, there are premiums that will be built into the market as things continue, or even if things get better. There is a 3 to 6 month lag between the damaging effects of what's going on right now and the actual realized consequences of those effects in the future. It takes time for this stuff to work its way through. So I will be using this tool here going forward so we can track all these metrics in real time so that I don't have to get all of the information from all the articles and do it by hand. I can have ChatGPT or Gemini or Claude scrape the web, grab the inventory numbers, grab the current metrics, and then put them into the model here. So the trading plan for today is going to be definitely paying attention to the S2 here in the NASDAQ. We will see if this level is going to hold or not. If the market does start to sell off, it could start to sell off rather violently, as there's been no correction for weeks. The S&P could start to sell off here below 7,400. I mean, the S&P could easily drop 100 or 150 handles and still be in a bullish sort of phase. The NASDAQ can drop 400 or 500 handles and still be bullish. I went over this the other day, last night, with the maximum decline that yields a new high. And I will demonstrate that right here. So if we look here and we roll this back a little bit, we can see that the decline line is right here in blue. This was how far the market broke before making a new high right here above 28,900. So we can see that this decline is starting to ratchet up. So this is the bullish first base buy here. So more longer term players are looking at things like the maximum decline. How far did the market move down before it made a new high? So we will definitely get some buying here if the market dips enough. So I am looking for that. In the crude oil, the maximum decline is about, let's see here. Let's see where they picked it up. My chart is frozen. All right, well, we're going to have to wait. Let's see here. Let's see if I can get the crude oil maximum decline here. Okay, so we can see the maximum decline here in crude. So in crude oil, it is significantly lower. Well, we've had a lot of volatility here in crude. So the crude oil actually broke about 400 or 500 ticks before it made a new high. So we're on a pretty powerful rally here up from last night in the crude oil. So the crude oil can now drop quite a bit and still be in a bullish sort of posture due to the fact that we have war escalation, and now the daily chart is starting to turn up, and then we have, gasoline supporting this. So the energy market is definitely strong here. So the market is strong, and now the energy market is strong. But one of these two is not really telling the truth. The crude usually goes down and stocks go up. And then if the crude goes up, everybody panics and then stocks go down. So we will see how this all plays out by the end of the day. There's probably going to be some news headlines, and maybe some more peace talk negotiations are going to be floated out, but the market is starting to catch on that there's really no substance or material basis for the ongoing peace negotiations. They're going to have to figure out some other way of continuing to propel the stock market higher and continuing to normalize the war, or somehow make it seem like the war is not as bad as it actually is. Hopefully, I will get some good script demonstration videos for today. I did do a nice one last night, so that is up there for you guys to check out. It's part of my Asian opening future strategy guide. When you get a chance, pop that on, and I go through how I'm using scripts to trade the Asian market open. I cover entry signals, risk management, and approaches for trading the after hours markets, which have slightly less liquidity than regular sessions. So if you're inclined and you're doing a little trading, or you're working with scripts to trade, definitely check that video out. So I will let you guys get back to it. Good luck out there, and I will see you on the next one.